Hello, I'm Ivan Gruhl, Co-Chief Investment Officer with Avantax. Today we'll provide a market update for February. We'll start with a recap of returns for January and then shift to an update on fourth quarter earnings, policies, and our outlook going forward. Stocks around the world picked up right where they left off last year as we saw positive returns across the board in January. Over the course of January, the S&P 500 added another 2.8% in total return, while the Russell 2000 Small Cap Index rose by 2.6%. International developed markets led the way higher, rallying 5.3% through the first month of 2025. Emerging market stocks lagged the broader markets, but managed to add 1.8% in total return for the month. January saw market leadership broaden out, with 10 of the 11 S&P 500 sectors in positive territory. Sectors like healthcare and financials were among the top performers, while technology stocks were the lone negative performer. The emergence of low-cost Chinese artificial intelligence model DeepSeek sparked concerns over the dominance of AI leaders like NVIDIA and Broadcom, leading to a sell-off in many artificial intelligence-related names. Bonds saw a solid month of returns as well, as healthy coupons helped cushion the volatility in rates. Both taxable and municipal bonds finished the month higher by about 0.5% in total return. Looking ahead, we can expect to see continued volatility in interest rates, but with average yields on the taxable and municipal bond indices around 4.9 and 3.7% respectively, we remain positive on the diversification benefits and return outlook in bonds going forward. As we turn the page on January, the U.S. markets are in the middle of reporting fourth quarter earnings results. Roughly 40% of the S&P 500 have reported results, and the earnings growth has been very robust. According to FactSet, the S&P is on pace to post year-over-year earnings growth of 13.2%, which would mark the strongest earnings growth rate since the fourth quarter of 2021. As this next chart shows, 7 of the 11 S&P sectors are on pace to report positive year-over-year earnings growth. Earnings growth continues to provide a strong backdrop for the markets and supports relatively elevated valuations in stocks. As we look to the months ahead, the markets are squarely focused on the new administration and the potential impacts of what we call Trump 2.0 policies. As this next chart shows, announcement of tariffs on our big three trading partners, Canada, Mexico, and China, have put the markets on edge heading into February. These tariffs could have broad-reaching effects on the global economy, trade, inflation, and the markets. But with that said, the current situation around tariffs remains very fluid. In fact, following the initial announcement, President Trump has already agreed to delay tariffs on Mexico and Canada for 1 month, and it is likely that further negotiations will ensue. If tariffs are implemented as proposed, we can expect to see further inflationary pressure alongside slower global and domestic growth. So looking forward, while investors have every reason to be concerned about tariffs and a trade war, the good news is that last week's GDP report showed that the U.S. economy entered the year with plenty of momentum, with GDP Now data currently showing a 3.9% growth rate for the first quarter. We expect elevated volatility in the months ahead, as a trade war has the potential to drag on current growth and profits while increasing inflation and interest rates. In the face of this uncertainty, we urge investors to stick with their long-term goals and maintain a diversified portfolio that includes domestic sectors and asset classes less reliant on imports, such as small-cap companies. So that's what we have for this month. Thank you for watching and have a great day.